For most of human history, charging interest was not considered smart finance. It was considered dangerous. In many societies it was treated with suspicion, restricted by law, condemned by religion, and sometimes punished more harshly than theft. Not because ancient people misunderstood money, but because they had already seen what happens when debt begins to grow faster than life itself. Today interest is everywhere. Mortgages, credit cards, government bonds, student loans. Entire economies run on borrowed money. Banks create credit. Governments issue debt. Global financial markets price the future. But thousands of years ago, some of the world's most influential belief systems tried to slow this mechanism down, not out of superstition, out of fear that it could destabilize society. To understand why religions tried to regulate money, we have to step back to the moment when money itself was first invented, because the story most people learn is wrong. Money did not begin as barter between strangers swapping goods. It began as obligation, as recorded debt. Long before coins existed, long before markets connected distant regions, the earliest cities of Mesopotamia were already running complex economies. In places like Uruk and Babylon, temples and palaces organized production. Farmers received land, workers rations, shepherds managed herds. Everything was tracked. And the tracking system was simple but revolutionary: clay tablets. On those tablets scribes recorded who owed what to whom. Bushels of grain, weights of silver, days of labor. These were not coins circulating through markets. They were accounting units, a way to measure obligation. Money existed first as a record of debt. Once a system exists to measure what is owed, lending becomes possible. And once lending becomes possible, time enters the equation. A farmer borrows grain to plant a crop. Months pass before the harvest arrives. The lender accepts the delay, but demands compensation for waiting and for the risk that the harvest might fail. So repayment is set slightly higher than the original loan. Interest appears. This is the second hidden truth about the birth of money. Interest did not emerge from commerce or trade between merchants. It emerged from agricultural lending, from the gap between planting and harvest. But this simple innovation introduced a strange and powerful property. Debt could grow automatically. Crops do not double every year. Labor does not compound endlessly. Real production is limited by weather, soil, and human effort. But interest does not share those limits. It multiplies according to mathematics. And ancient societies noticed the consequences quickly. When harvests were good, loans could be repaid. But when crops failed or floods destroyed fields, the debt did not disappear. It kept growing. Families that could not repay their obligations were forced to surrender land, livestock, or labor. Debt slavery became common. Farmers pledged children as collateral. Land accumulated in the hands of creditors. Independent households gradually lost the means to survive. This created a problem that went far beyond economics. If too many citizens lost their land and freedom, the state itself became weaker. Tax revenue declined. Military recruitment collapsed. Social unrest spread, so rulers began to intervene. In Mesopotamia, kings periodically declared debt cancellations. Entire categories of personal debt were erased. Families were freed from bondage. Land was returned to its original owners. These decrees were not random acts of generosity. They were calculated political decisions. A society drowning in compound debt could not function. The danger of interest had become clear. As civilizations grew more complex, religious traditions began absorbing this economic tension into moral law. What had once been a political intervention slowly transformed into a moral rule. One of the most famous examples appears in the Hebrew Bible. In ancient Israelite law, lenders were warned not to charge interest to fellow members of the community. And every 50 years, a radical reset known as the Jubilee was supposed to occur. Debts were forgiven. Land returned to ancestral families. Bondservants released. At first glance, these rules look purely spiritual. But their economic logic is unmistakable. Without periodic resets, compound debt would concentrate land and power in the hands of creditors. Over generations, the entire social structure could collapse into permanent inequality. Religion was acting as a stabilizer. Early Jewish communities treated lending between members of the same community differently from lending to outsiders. The goal was to protect internal social cohesion. Interest within the group threatened that cohesion. Centuries later, early Christianity adopted a similar stance. Many church leaders condemned usury outright. For them, the issue was not simply profit. It was the idea that money could generate more money without labor or risk. To early Christian thinkers, wealth produced purely through time appeared unnatural. Money was supposed to serve human activity, not dominate it. Charging interest seemed to reverse that relationship. By the medieval period, this belief had become deeply embedded in church law across Europe. Usury was formally prohibited for Christians. Lending with interest was treated as a moral offense, yet the economy was evolving. Trade networks expanded across continents. Merchants financed long voyages and large inventories. Kings needed enormous sums of money to wage wars and maintain armies. Suddenly, the prohibition on interest collided with the practical needs of expanding states. And this is where the story begins to twist. While religious doctrine condemned usury, financial reality kept demanding credit. Merchants found creative ways to structure loans that technically avoided the definition of interest. Fees, currency exchanges, and partnership contracts disguised lending arrangements. Behind the scenes, credit continued to grow. Meanwhile, another religious tradition developed its own powerful restriction on interest. Islamic law prohibited riba, a term often translated as usury, but historically referring to unjust or excessive increase on loans. Like earlier traditions, the concern was not simply moral purity. It was the potential exploitation created when money generated guaranteed returns, regardless of real economic outcomes. Islamic scholars argued that wealth should grow through trade and shared risk, not through guaranteed gains from lending. This principle shaped financial practices across much of the Islamic world. Again, the motivation was not ignorance of finance. It was recognition of its power. Across Judaism, Christianity, and Islam, very different cultures arrived at remarkably similar conclusions. Uncontrolled interest could destabilize society. But here is the deeper twist. These prohibitions were not only moral rules. They were early forms of economic regulation. Religion was performing a role similar to modern financial policy. It attempted to limit mechanisms that could concentrate wealth and weaken social structures. In other words, these traditions were trying to control the same force that ancient kings had struggled to manage centuries earlier: compound debt. Yet history rarely allows such systems to remain stable for long. As European states grew stronger during the late medieval period, rulers began relying heavily on borrowed money to finance wars and infrastructure. Merchant bankers in cities like Florence and Venice became crucial intermediaries between governments and capital. Families such as the Medici mastered the art of lending to monarchs while navigating religious restrictions. Gradually, the prohibition on interest weakened. Economic necessity began reshaping moral doctrine. New financial instruments blurred the line between legitimate investment and forbidden lending. Interest slowly became normalized, especially when tied to commercial expansion and state finance. Once governments began borrowing regularly, the scale of debt expanded dramatically. States discovered that credit allowed them to mobilize resources far beyond their immediate tax revenues. Armies could be raised quickly, empires could be funded. Expansion accelerated. But the underlying mechanism remained the same one feared thousands of years earlier: debt growing through time. By the 17th century, a new institutional framework emerged that would permanently transform this system. The creation of central banking formalized the relationship between governments and lenders. The founding of the Bank of England is a famous example. Private investors funded government borrowing in exchange for interest payments backed by taxation. Public debt became permanent. Instead of periodically resetting obligations through jubilees or religious prohibitions, governments began rolling debt forward indefinitely. Old loans were replaced with new ones. Interest payments were sustained through continuous economic growth and expanding credit. A new financial architecture had been born. Commercial banks developed fractional reserve lending, allowing deposits to support multiple layers of loans. Each loan created new money in the form of bank deposits. Money itself became inseparable from debt. When a bank issues a loan, new purchasing power enters the economy. But that loan must be repaid with interest, which means more money must exist in the future than exists today. To sustain the system, new credit must continually be created. This dynamic lies at the center of modern economies. Governments borrow to finance spending. Corporations issue bonds to expand operations. Households rely on mortgages and credit cards to access housing and consumption. The scale is enormous. Global debt now exceeds hundreds of trillions of dollars. Interest payments shape everything from national budgets to individual life choices. Yet the ancient tension has never disappeared. When debt grows faster than real economic production, instability emerges. Financial crises erupt. Banks collapse. Governments intervene. Each crisis forces societies to confront the same question ancient rulers once faced. How much compounding debt can a system sustain? Modern policymakers attempt to manage this tension through tools like interest rate adjustments, monetary policy, and financial regulation. Central banks influence borrowing costs to slow or accelerate credit expansion. But the fundamental mechanism remains unchanged. Money enters the system primarily through lending. Debt carries interest. Time amplifies obligations. Asset owners benefit from rising values fueled by credit expansion, while borrowers bear the long-term cost of repayment. Over decades, this dynamic contributes to widening inequality. Wealth compounds for those with capital. Debt accumulates for those without it. The patterns look strikingly familiar to the ancient world. Land concentration once followed debt defaults. Today, asset concentration often follows financial crises. What early religious traditions understood was not simply morality. They recognized the social consequences of unchecked compounding claims on future production. Their rules were attempts to draw boundaries around a powerful financial mechanism. Those boundaries gradually eroded as economies expanded and states demanded greater financial flexibility. The modern system did not reject the ancient warnings. It absorbed them and tried to manage them through institutions instead of prohibitions. Central banks, regulatory agencies, and international financial organizations now monitor credit flows and attempt to prevent systemic collapse. But they are still dealing with the same underlying force: debt growing through time. And the question that troubled priests, prophets, and kings thousands of years ago still lingers beneath the surface of global finance. If money can grow faster than the real world that supports it, who ultimately absorbs the imbalance? That question leads to three powerful takeaways. First, money was never purely an economic invention. From the beginning, it was tied to systems of power and obligation. Religious rules around finance emerged not only from moral philosophy, but from attempts to preserve social stability. Second, interest is not inherently destructive. It can coordinate investment, reward risk, and support economic growth. But when the compounding claims created by interest grow faster than real production, societies face pressure that eventually demands correction. And third, the debates surrounding debt, inequality, and financial stability today are not new. They are the latest chapter in a conversation that began thousands of years ago when the first clay tablets recorded obligations between farmers and temples. What has changed is scale. The ledgers are now digital. The lenders are global institutions. The borrowers include entire nations, but the mechanism remains. Money created through debt, debt growing through time, and a system constantly trying to balance expansion with stability. Ancient religions tried to solve this tension with moral boundaries. Modern economies attempt to manage it with policy and institutions. Neither has eliminated the underlying problem, which leaves one final question hanging over the entire system. If the ancient fear of compounding debt was justified, what happens when the modern world reaches the limits of managing it? Subscribe to The Dark Economy for more hidden finance documentaries.